This is the second video in our video series on borrowing power. In this video, we're going to be going through just the basics on what affects your borrowing power. We're not going to go too deep diving into the specifics of each category, but it's just good to know up front what are some of the things that impact your borrowing power. Okay, we'll go through just a simple calculator, work our way from the top and go down, and just let's start from the top. How many applicants you've got and how many households those applicants are living in. So I'll give you an example. Let's say we're dealing with a single person just living at home. They're going to have very low expenses, okay, especially if they're living with parents. Then you've got de facto partners that are living in two separate households, so a bank would treat them as having two sets of living expenses, and then we would need to see, are they going to be living in the future property? Okay, so will, at the time that they buy, will those living expenses be combined? And if that's the case, then that's how they'll be treated at the time that they go for their application. Okay, then we've got de facto and we've got married couples. Okay, so we've also got some of the other situations where you have two single parties or two separate couples, and you've got sisters and brothers buying together as well. So it's all treated differently depending on how many applicants there are in and how many households that there are. Then we look at how many dependents under 18. So right up until the age 18, we've got to list the amount of dependents, and half the banks do checks in the background, and they'll check Medicare cards and things like that as well. So if people think that they can hide these things, they can't. Then we go down to living expenses. Most banks will have what's called HEM, which is a benchmark that they set for living expenses. So if you've got two adults, one child, both adults are on 60 grand a year, and they don't have a whole lot of outside debt, and they've got the one home loan and one home that they're living in. A bank might say, a big six bank might say the benchmark, the lowest that we're willing to use on the last 1,000 applications that we've used, might say 2,800 to 3,000 living expenses. And then what they'll do is they'll get a client to list what they think it is, and then the lender will talk them through each item. So there's about 10 different categories, and then we itemize them, what we do there. Then we check it against the benchmark to figure out if it's realistic or not. Then we go back to them, discuss it a little bit more, and then from there some banks use modeling tools. So what they'll do is they'll get your bank statement, and then they'll use a modeling tool, go through all the direct debits and credits, add it all up, and then average it, and then figure out if that's close to what you've used or if it's higher. And if it's higher, a lot of banks will ask you to justify that if a lot of that was once off expenses, or if a number of those expenses were normal and some of the categories that you listed were low, and then they'll ask you to bump up those categories. So that's how living expenses work. And it always needs to be the forward adjusted living expenses, which confuses clients a little bit because, you've got a person at uni, they've just gotten their first job, they're living with the parents, but then they don't know what their living expenses will be when they, move into the property. So that's something that as a broker and a lender, we need to be talking to clients about and making sure they understand. It's the adjusted living expenses at the time that they move into the property, plus using what you're currently doing as a baseline. Okay, so that's that. Then we start looking at your income. So we go through your base wage. Are you PAYG or self-employed? And if you're PAYG, we go through your base wage. Are you a contractor or are you full-time? Are you part-time or casual? Then we start going through your overtime, your allowances, your commission, your bonus, and banks will treat you very differently based on how you answer a lot of those questions. if a lot of your income's coming in on a casual basis, a lot of banks will want it averaged out over a 6 or 12-month period. Okay, as far as your base wage goes, if you've just moved to a new job, a lot of banks, well, 99% of banks won't use your bonus, even if you've shown an average bonus over the last 2 years at prior companies. They won't use the current bonus because you've been in that job for less than 2 years. Some banks, they'll cause issues if you're in a probation period or if you've moved jobs in the last 6 months. So there's a number of factors there. And then if you go down the self-employed route, are you a company or are you a sole trader? Okay, if you're a sole trader, everything runs through your personal tax return, so you'll supply your last two and figure out if there's any gaps in the income, and then depending on the bank that we're looking at, some banks will use the latest year even if it's gone up a lot. Some banks will average it out if it's within, say, 20 or 30% the income figures of the last 2 years, or some banks will use the lower of the figures if there's too big a gap in the income. Okay, that's the same with companies. If you're a company, they'll look at your net profit, they'll look at the salary and wages that you pay yourself, and then there's some banks that will factor in company debt on your serviceability, so your borrowing power. So some banks don't. So it can get quite complex in the self-employed space. All right, and then we go down to your liabilities. So simple things like personal loans, car loans, student or help debt, zip pay or afterpay. You've got a number of things that affect you, as well as, do you have any current mortgages at the moment? What are the terms on the mortgage? How many years left on the mortgage? That affects your borrowing power. What is the structure? Is it principal and interest or interest only? Not a lot of people know that interest only loans reduce your borrowing power. So I'll give you an example. If you've got a 30-year mortgage and you've got a 5-year interest only period, okay, you're actually squeezing all of your principal and interest repayments into a smaller window, so from 30 years to 25 years. So that reduces your borrowing power because it increases the requirement of repayment over the 25-year period, okay, instead of stretching it out over a 30-year period. Okay, so you've got those things in regards to a mortgage. Also, the rate that you're getting. Okay, not a lot of people know that certain banks will go off the revert rate. So I'll give an example. If you're looking at, say, the Westpac Group, Westpac St George, Bank SA, Bank of Melbourne, Rams. Let's say you get a really great 2-year fixed rate, and you went and you really wanted to maximise your borrowing power, and you got a really good 2-year fix owner occupied at before all the rate changes. Let's say it was just a 1.89% 3 months ago. Absolutely amazing, but they don't run the borrowing power on that. They run it on the revert rate. So after the 2 years, you roll off onto variable. What will you get on that variable rate with the lifetime discount that you've got at the time that you applied? Okay, so that could be 2.6 or 2.5% 3 months ago on variable, when you could have gone to another bank that actually does it on the 2-year fixed rate and increases your borrowing power by 30 to 60 grand. Or we do the sneaky sometimes. We get you pre-approved and settled on variable. We get the benefit of the borrowing power uptick, and then if a client chooses to change their mind after settlement and fix the loan, then that's completely up to them, and it doesn't affect the borrowing power that way. So you just need to know a whole number of these different rules with different banks to maximize these things. Okay, then we're looking at, that's for current liabilities, then we're looking at the future liability. So again, your mortgage, what you're looking to get, what the loan size is, what the current loan limit is, how much money you're going to be sitting in the offset or the redraw account. That affects your current liabilities, not your your future ones, so your future home loan. All right, so that's really a top-down approach on what banks look at and how they look at it. And then the next couple of videos, we're going to go into a little bit more deep dive into each one, and then talk really about how we can increase your borrowing power. All right, we'll see you on the next video. All right, then, bye.